Hi, my name is Kevin Retcher. I'm the owner of First Meridian Mortgage. Today, what I want to discuss is refinancing your mortgage and the costs that go with it. Okay, so typically there's a number of closing costs that are one-time transactional fees associated with a refinance. You have an appraisal, credit report, sometimes tax service, flood cert, title company closing fee, maybe a binder, maybe a title search, closing protection letter, lender's title insurance, recordation, to name a few. So typically, let's just say on average, on a $400,000 deal, it's probably about $4,000, typically close to 1%. Smaller the loan, higher the percentage, bigger the loan, lower percentage on the cost of refinance. Each jurisdiction can also be different. Virginia versus Maryland versus DC all have different closing costs, even for the same loan amount. And that's basically because title insurance is different, and also recordation can be treated differently in each county. Regardless, there's kind of three types of ways that you're going to pay for the closing cost. Typically, there is the no-cost refinance, what I call a hybrid no-cost refinance, and then an all-in client pays all the closing cost type of refinance. Okay. In some cases, the banks like to add origination and points on top of the closing cost also. Okay, so let's get into some of the advantages and disadvantages of each of these. Okay, so one of the first things that you got to compare is rate. A no-cost refinance, you are taking a slightly higher interest rate to cover the closing cost. So it's not that the costs are not there, but you're getting a lender credit toward those closing costs. So if you're starting up off with an interest rate at 7%, if you can get 6% and have all the costs paid for, then that, of course, makes sense to do. It's a free refinance or a no-cost refinance. It's technically built into the interest rate. The bank thinks that they're going to get paid that interest rate for 30 years. They price out the loan and then pay the lender their fee, and then whatever's left over as a credit goes toward your closing costs and covers those. So typically it is a slightly higher rate, probably an eighth to 3/8 for a no-cost refinance. When looking at the rate, a hybrid is going to be a slightly lower rate, but you're going to get a lower credit in conjunction to pay those closing costs. And then, of course, the lowest rate is going to be when you pay all the closing costs and potentially points and origination. You're kind of saying, I'm done with refinancing here. Here you're saying, I don't know if I'm done, but I don't want to pay cost, or I want to pay minimal cost. Okay. Next, when again going to where the cost is, no cost is the lowest cost. You have slightly higher cost on a hybrid because you're getting less credit, and then on an all-in has the most cost, and you can either pay those or roll those in a lot of cases, but it has the highest recoup time also. So when you're looking at doing the refinance, you want to look at the ROI, or return on investment. On a no-cost refinance, since you're lowering the interest rate, not rolling in closing costs, not having to pay it out of your pocket, you're instantly saving money on a no-cost. On a hybrid, you have to calculate versus the no-cost and determine what your recoup time is, okay? Typically, you want that recoup time to be 6 to 9 months on average, okay? When you're paying the closing cost, and any points or any origination. You typically want your ROI or your recoup time to be under 24 months. You typically want to do this when you think you're at the bottom of the market. So you want to pay when you're at the bottom of the market when it comes to interest rates. So if interest rates get back down to 2%, then go all in, right? If we're in the midst of potential Fed cuts in 2024, the first cuts in a couple years, you typically want to stay in the no cost to the hybrid range to, in fact, not incur a lot of the cost. Take your opportunities when they arise. So if you can go from 6 1/8 down to 5 1/2 for free, grab it. Typically, you got to wait 6 months, typically on most originations, to be able to do it again. But this keeps the gunpowder dry. This says I'm all in, right? So if you want to pay the closing costs and get the lowest rate, you can do that. Make sure your recoup time is 24 months or less, but you are kind of saying you're done. When you want to go all in is when you are going to potentially be self-employed and you know your tax returns work now. That's one instance. Another instance to go all in is if you think you're going to turn it over into an investment property, and refinancing now as an owner-occupied is better than what it would be as an investment property later, would be another instance. But generally speaking, keeping your gunpowder dry and doing a no-cost or a hybrid right now in a downward moving market makes the most sense. When that changes, then you may switch to the all-in, okay? Reluctance, when talking about reluctance, is people doing no-cost or hybrids are more apt to pull a trigger because they're saving money instantly, or it's a small finite time of maybe only a few months to recoup their closing cost. When you go all in, you're saying, I'm not going to do this again for a while. I have a reason to go ahead and pay and get the lowest rate now that I can, versus being patient, taking your opportunities when they are available. So this is kind of a recap of what I deem as the 3 types of refinances when it comes to categorizing cost. There are other types of refinances, rate and term, cash out, and things of that nature. But generally speaking, these are the 3 types of refinances when it comes to closing costs. My name is Kevin Retcher. I'm the owner of First Meridian Mortgage. Our phone number is 703-799-5626. And to all the Marines out there, I say Semper Fi. I'll talk to you soon.